Hi there, this is Christian Dye from Latitude West Financial, and this is your July stock and real estate market monthly report. I've got Dara Fahy from Citywide Mortgages and Ryan Runte from Stonehouse Realty helping us to understand what is going on in this volatile market we're in right now. Just a quick reminder that the information given today is not to promote the buying or not buying of any real estate or stocks. We advise that you do your own research, but this is for educational purposes only. I want to dive right into it because I think the really hot topic right now is interest rates, mortgages, inflation. So, to help us make sense of this, we want to start with Dara as to what is going on, especially with the July 13th announcement of the increase in the rates by 1%. So, Dara, tell us what is happening and what do you think is going to happen? Dara, I think you're still on mute.
That's good. Thank you for pointing that out.
Yeah.
Yeah, hot topic indeed. Last week, July 13th, the Bank of Canada increased its lending rate by 1%, which was a bit of a surprise move. The US Federal Reserve had increased their rates by 0.75% last month. So the expectation here was that Canada was going to follow suit. They took it one step further and went a full 1%. The reason cited for the increase, they didn't change. Global inflation remaining high, war in Ukraine affecting the supply chain, pandemic lockdowns in China affecting the supply chain, our economy running strong with almost no unemployment, and we have over 1 million job openings right now, if you can believe it. Anybody who wants a job can get one. So it would definitely appear that inflation is here to stay for a little bit, and the bank is taking drastic measures. So the not so good news in that is that variable rate mortgages and home equity lines of credit and anything variable is going to go up has gone up by 1% accordingly. Just to give you an idea of what kind of impact that has, it's about $57 per 100,000 of mortgage. So that's an important number to keep in mind. As drastic as a 1% increase sounds, the actual effect on payment is not so bad. The other not so good news is I think things will get worse before they get better. I do think we'll see some further rate increases over the rest of the year, possibly as much as 1%. And fixed rates, which have increased a lot to start this year in anticipation of these rate hikes, they're going to increase too. So I think we're going to see potentially 1% higher going forward in both fixed and variable rates. Some good news and some silver linings. In the Bank of Canada's release last week, they did acknowledge that they were front-end loading here. So I don't think that this drastic move necessarily means that we're going to end up at a higher point than we originally expected. I think they're just trying to get there quicker and have a bit of more of a drastic impact, which is a good thing. I think that'll help us to get through this faster. The report indicated that their expectation is that inflation will taper towards the end of this year, dropping to around 3%. And possibly 2024 we see 2%, which is their target. So translation, this should be short-lived if all goes well. Some other interesting news: last week we saw the bond markets and fixed rates actually stabilize a little bit. So that's positive too. Maybe we don't see quite as drastic an increase in the fixed because a lot of this was priced in already.
So if I'm interpreting this correctly, you're saying that rates are going to go up very, very quickly, as we've already seen it, and they're going to go up even more because the Bank of Canada is just trying to get control of inflation. So instead of dragging it out, they're kind of really, really trying to, blast it with a bit of a cannon. But once it gets under control, it's very probable that they might actually bring the interest rates back down in a year or two. Is that correct, Dara?
Yeah, that's absolutely correct. I think, in my opinion, they didn't start raising rates quick enough and they waited too long. So I think they are trying to make up some ground here and have a drastic impact. So I do agree with that. There's a very good chance that this could put us into a recession. And if that were the case, rates could come back down. It's just a question of how high do they go up in the meantime in the next 12 months, and that's hard to say. But I definitely do think that we will see rates start to come down towards the end of next year, and that's a common narrative that we're hearing from a lot of the economists that we follow.
Yeah, and I guess a couple of things to keep in mind even though these numbers in this current generation are, outrageous, 4.25 or 5.5% on a fixed, they actually still historically are low for Canada. In those people who survived, the 80s and the 90s, we're seeing double digits, 11, 12, 18%, where they would have killed for a 5.5 back then. But of course, their housing prices were significantly less expensive as well. But I guess one big question, Darren, I know this is kind of your professional opinion, and people shouldn't take this, as word. They should, of course, take this with a grain of salt. But right now, would you still be recommending for a fresh, brand new mortgage a variable or a fixed?
I absolutely still like the variable. There's still quite a significant spread between the two. And you're to take a fixed, you're really paying quite a big premium to have that certainty on payments. It seems counterintuitive, and I've said this in the past. We know we're going to see more increases, and that variable rate will get up there. But why prepay the bank that interest? Take the variable, enjoy the payments while they're low, let it get there on its own. Overpay it if you can. So I do believe one will come out ahead on average with the variable in the long run. It's definitely a long game. That said, I know it's not for everyone. People have to sleep at night. Risk tolerance is important. So I think it's important thing is to consult with an advisor and a mortgage specialist on that and figure out what's the best situation. But from a bird's eye view, I do like the variable, absolutely.
Yeah, and I guess with me, what I always do is I always tell clients, let's do a financial, plan. Let's figure out if you could even handle a fixed. And if we do a variable, let's figure out a strategy for a variable so you don't get caught, with your pants down, and suddenly you're in a situation where you can't afford your mortgage 8 months later or 12 months later. But everybody should always get pre-qualified. If you are thinking of making the jump into real estate or making a move up, just because, as we've always said, if the rates go up, you would get the lower rate. If the rates go down, you would get the lower rate. So always get pre-qualified. But thanks for the update, Dara. It's incredibly important information. I know a lot of people might be renewing or might be trying to make that decision whether to do fixed or variable now. And it is a turbulent time right now in the mortgage market with what is going on with the recent increase. But thank you for letting us know. We're now at 4.7%. And according to the data that you're receiving, we'll probably be at 5.7 end of year, correct?
Exactly. Yeah. That's again an estimate, and it's very difficult to predict. But that's I think a realistic expectation for sure.
Sure. Okay. Thank you so much, Dara, for the
Very
update.
welcome.
I want to share some statistics over here on housing and Vancouver housing. So right now, it has been an interesting last 2 months, because it's pretty much the last couple of months is the first time we've actually seen a decrease in Vancouver housing prices. So now the average residential home in Vancouver, when you combine townhouses, condos, and detached houses, about 1.235, and that's actually down by about 2% from 1 month prior. But it still is an increase over last year. Now, if you take a look at, sort of across the board, a detached home in Vancouver average price is still $2 million. Average days on market is still 21. Townhouses, 1.1 million, average days on market 15, and condos 766 with average days on market 17 days. But the only thing is that these numbers, are always based off of data that was at least 1 month old, right? So that's why, of course, we want to take a look more than just the data. But the sales to active listings ratio, if you'll recall, how do we know whether prices are trending up or trending down? When the sales to active listings is below a 12, that means they're trending down. When they're above a 20, that means they're trending up. Now, we saw the numbers through 2021 high above a 20, and that's exactly what ended up happening. Prices ended trending upward. Now we're, April, they started to go lower. May, they started to go lower. Now we take a look at June. Once again, they start to go lower. As a matter of fact, if you take a look at the houses, they're actually below 20 now. And whatever happens to houses, usually townhouses and condos tend to follow. And this is just looking at the raw data. But this is why we need Ryan and his expertise to tell us this is what the data says what's happening, but Ryan knows exactly what's happening because he is the person in the Lower Mainland, buying and selling real estate on behalf of his clients. So Ryan, tell us from your perspective, what is happening right now when it comes to housing prices, when it comes to sales activities from what you see?
Yeah, so I think like the stats for the board are a little bit behind. We're starting to see most product, the prices are dropping, especially in the Fraser Valley, for example, because there's a lot of inventory. Just as one example, I was looking before this meeting in Langley, there's 256 townhomes listed right now, and the average price is 916,000. And a few months ago, the townhomes in Langley were at about $1 million. So even though it's not really in the full stats yet, because they're factoring in the full Lower Mainland, you can start to see prices are coming down. And I would bet because the rates have gone up so quickly, so fast, that it's quite possible we'll see a 10 to maybe even 14% decrease next year, which is not the end of the world. I know a lot of people are freaking out, but we've had the last couple of years have been so busy. It's really just kind of scaling off from that. But with the interest rates being so high, there's definitely less buyers in the market, and we're starting to see more inventory. So I think we're going to go kind of from balance to possibly a decrease in prices.
Got it. Got it. Now, when you say decrease in prices, you're essentially saying from the value that they were being sold last year, or are you saying from, its absolute peak, whenever that happened to be?
Yeah, I would say the peak, it's difficult because these ones in Langley, for example, a couple of months ago, their neighbors were getting $1 million and you're getting multiple offers. When we were doing these updates, we were seeing, 5, 10 offers. Now, because there's so much inventory and there's less buyer pool, I would say from the peak. So, it's quite possible. I would say 10 to 14% from the peak. So kind of looking January, February, earlier in the year, you saw those multiple offers and the peak pricing. So I would say from that.
Sure. And then, is this across the Lower Mainland, or would you say there's just certain areas or pockets, or would you say, because I know you do Fraser Valley, you do Vancouver, you do the Tri-Cities, you also do Burnaby, but are you saying that this is kind of all across the board?
Yeah, I think it will be all across the board. We're seeing Fraser Valley's being hit the hardest because I think there's more inventory and that's where a lot of people moved. But I think it'll be across the board. We're starting to see in Vancouver as well. I'm starting to see some pretty big price drops on houses, for example. I just saw one on the west side that I'm actually looking at tonight. They dropped their price 200,000. So I think it's quite possible we're going to see it across the board. I mean, the biggest thing right now is just with these rates increasing so quickly, there's less buyer pools for each property. So now I think, before you have 5 to 10 buyers for a property, maybe now you have 1 or 2. So that's going to be the biggest issue right now. There's just not as many buyers that can afford the same product.
And because of that, I guess in your perspective, if something was fairly correctly priced in today's market, let's say a house, what are people coming in with? Are they coming in with asking about, is the above asking days that's gone? Or is it like 95% of asking? Like what can people expect?
Well, it's interesting. Some realtors or some product is still being posted below to try to get the multiple offers, which I don't think this is the correct market to do that. But as an example, most of the detached houses in Metro Vancouver that we've been seeing and that we've been writing offers on is about 50 grand under asking. So we just had one the other day on Dundas Street in Vancouver, and we offered 50 grand under asking. So I would say that's probably going to be the average. If you're priced correctly, I think you're going to get a little bit off of the asking price. There's some people that are still trying to get multiple offers, so they're actually pricing it, a few $100,000 lower, hoping to get a lot over that, but that strategy doesn't seem to be working now. So I would say for the most part on the detached house, you're probably 50 grand below asking. Townhomes and condos is not as aggressive, but it really depends on the product and location, etc.
Got it. Got it. And, right now, tricky question. Let's say you were planning on moving as an upgrade. Let's say I'm going from a townhouse to a house.
Yeah.
In this market, would you be selling first before you put in an offer, or would you buy with condition to sale, or which direction would you go?
Yeah, we have a couple of those situations right now. We always recommend to sell first because you know exactly what you have to work with. And even though the market's slower, a lot of sellers don't want to take a subject to sale because they don't know if your product's going to sell. So I would say to be more competitive, you're better off to sell first and just ask for a longer date. So if you saw your place and you ask for 3 or 4 months, then we can find you something on the buying side. Because yeah, we have that situation now with a couple clients and they want to find something first, but we just don't know exactly what their place is going to end up at now with the market changing so quickly. So you're better off to know exactly what you have to work with. And then you're also more attractive when you're buying.
Yeah, okay. And let's shifting gears a little bit. What about for investors? For investors, would you say, hey, Christian, this is an area and a product that I think is a really, really good, solid investment, over the medium term or the long term? Because I know last time we've always talked about, the Fraser Valley, things like Langley and Surrey because of the SkyTrain lines, because of all the infrastructure that was being built there. But then they all got expensive. What would you sort of say that you feel is still a good deal for an investor?
I think it's still a good deal in those areas. So they officially approved the SkyTrain now. So from the King George to Langley Center, it's supposed to be done in 2028 and they're always delayed. So even if it's say done 2030, I think it's still going to be good out there. You're already seeing the prices come down quite a bit, especially in Langley. So I'm saying to investors right now is probably a good time because there's so much inventory. So 256 townhomes, for example, in Langley. So if you can get something, high 800,000, low 900,000, it's going to come back, especially because the SkyTrain is going to go out there, and that has been officially approved now.
Got it. Got it. Oh, this has been great. And so you sort of believe we are trending down. You
It
think that
looks like it. Yeah, it looks like it. I can't see us not because the rates have gone up so quickly. It's just really limiting the buyer pool. And then there's some buyers that aren't going to buy at all now because they can't get the product that they want. So someone that was approved for a townhome, maybe now they can only qualify for a condo. So, I mean, unless there's some changes and the mortgages are scaled back, which Derek kind of touched on might happen in the next several months, I think the fall is going to be slower. So it's not a horrible thing in the sense that it's a good time to buy, I think, because you're not competing with people for the most part, and you're getting probably money off some of the product, a decent amount off. So it's a good time in that sense. I think you can kind of be a little bit more choosy for buyers and you can get a decent deal.
Got it. Got it. No, thank you so much, Ryan, for the update. We always value this, and of course, we will connect with you if anyone is needing your help.
Sounds good. Thanks very much.
All right, Ryan. So to do a bit of a conclusion over here, we've always said the same thing. Don't try to time the market. It's a dangerous game to try to time this market. You need to work with a professional to see what you could afford. Lending rates, of course, going up due to inflation, but it is shifting towards a buyer's market for the rest of 2022, according to Ryan, and I tend to agree from what I've been seeing as well. What are we doing with clients? We're, of course, analyzing real estate for investment reasons. And if it makes sense to buy, we look very carefully at cash flow and cap rates, but we look at real estate not only here in our backyard here in the Lower Mainland, but across Canada. So that's some of the ways that we absolutely can help our clients in order to see what are these other opportunities, not just here in the Lower Mainland. We use things like a Monte Carlo analysis to figure out what is the greatest opportunity right now. And speaking of which, we should probably transition into the stock market and what is happening there. So, right now the S&P 500 is dropped, at the time of this recording around 17%, and it's around 39.50. Now, earlier, reports before we were saying that it was looking like analysts were predicting that would land around 5,000. Now, a lot of those analysts have, shifted gears in saying it's going to land significantly lower. Cryptocurrency, huge hits down, Bitcoin now 60%. Ethereum down 73%. Inflation massively on the rise at an all-time high of 8.6%. And we know the causes, COVID uncertainty, the war in the Ukraine, inflation. So one of the things that we really kind of need to be careful of in this really, really down market is on panicking. You don't want to panic. So now some stats. Bank of America has now believes that we're actually going to finish down in the year. So they were originally at 4,500. And they downgraded it down to 3,600. So they believe that we are going to be down. Because inflation is on the rise, that of course causes the interest rates to increase. Be very, very cautious of any stocks that are affected directly by rising interest rates, specifically tech. Technology sector is usually one because they typically are levered and now they have to pay those higher interest rates. So, unlike what we typically do in these reports, we often talk about individual stocks and individual sectors. Because everything is down right now, I want to talk more about the cycle of investor emotions. So here, when markets are trending up, there's this cycle of, optimism, enthusiasm. And that's when there's actually the greatest risk of loss, is when markets are up. And we've been talking about how markets pretty much went straight up for 10 years. And we kept saying, you got to be careful, because when they're this high, they're overvalued, they're overinflated. And then what ended up happening is, now we're trending down. And here, when you take a look at this, location of despair, that's actually the greatest opportunity for gain, is when markets are down. Investors can feel kind of this sense of urgency to sell off, but it's actually the best time to hold or to invest more. So we like data. So here's a cross section of the last 30 years. And what are some of the things that we're noticing over here is that when you had these negative points, the market is down 3%, the market is down 8%, here the market is down 34%. We also tend to then look at what does the markets look like afterwards in the following years? What does the rebound look like? And a quick little stat here, 75% of the time when the markets are down, they're actually up in the following year, 75% of the time. And then, of course, typically 100% of the time, give it 5 years and then they're all up. So you got to be careful if you're planning on stopping investing, or if you're planning on actually selling. So here's an example of an investor invested $10,000 in 1986 and missed the 10 best days on the stock market over the last 35 years. Okay. So because they were trying to time it, they were to try to pull their money out. So notice, if they would have missed the best 10 days, they'd be down $100,000 on that $10,000 investment, as opposed to just leaving it, invested in. If they missed the 20 best days, they'd be down all the way to 25,000, losing the majority of their portfolio. But just staying fully invested is, of course, the dollar cost averaging strategy. If you are investing money, you want to keep investing money because of the dollar cost averaging. And if your money is already there, you don't want to panic sell. You don't want to panic sell at all. And again, you should be working with an advisor if you're not sure what to do, because typically, if you haven't done an analysis, if you haven't done sort of a forward-looking pro forma, you're probably going to make a mistake. Okay, so a lot of people, we've always recommended to not be fully invested in stocks. That's why we want to diversify with other things, fixed income, bonds. So bond outlook, to contain inflation, central banks indicated that their intention to raise interest rates. Now, bonds compete by, of course, also keeping up with those higher rates, which means you get these higher bond yields as those rates start to go up. But here's the thing, as the interest rates rise, bonds offering less income than the current market must depreciate to provide a total return comparable to what is offered by the newly issued bonds. So the adjustment causes the whole bond market to actually drop, resulting in a negative total return seen in the first quarter. So note that during a period of rising interest rate, long-term bonds are more heavily affected than short-term bonds. So, bond yields right now, depending on the type of bond that you get, somewhere are hovering around 1% to 4% yields. Now, we believe that you should be diversified, but it should be the correct type of stock, the correct type of fixed income, the correct type of bonds. So the types of yields that we were looking over the long term were actually much better than that 1 to 4%. They were closer to 5.4% yields. So, that's the value of having an advisor. They can help you to make sure that you're getting the right thing. So by all means, if you're too heavily invested in stocks and you need to have more exposure in bonds, you definitely want to have a conversation with us so we can explain what our recommendations would be in order to keep your portfolio safe. So some stock conclusions over here. If you're a long-term investor, you absolutely should not be selling. If there is no necessary need for that money right now, you should not be pulling it out. If you're like, oh, I can't take the pain and the market's going down too quickly, too fast. It's exactly what all of the professionals say not to do, is to panic sell. What to do in 2022 is, of course, stay invested. Do a dollar cost averaging in those, solid ETFs, solid index funds, solid names, whatever they happen to be. So what are we doing with clients over here? Not to toot our horn too much, but our core portfolio, which we were recommending, which has a combination of multiple asset classes, is actually up 3% year to date. S&P 500 is down 17%. Our portfolio is up 3%. 3% in a down market like this is actually fantastic. So, if you're doing this on your own, look carefully and say, do I need to be taking on this much risk? Do I need some help in the returns that I'm getting? Because maybe you're upset with maybe you have 20% loss, 25% loss. The other thing that we do with our clients, of course, is we look at real estate opportunities as well as stock opportunities. What we're doing is we're finding real estate opportunities, and remember our motto: we like 20% down, cash flow with a cap rate over a 4%. Very, very simple formula. Finding those properties is very, very hard formula, but if you're our clients, we're able to help you to find those properties. It's just a matter of connecting with us. If you're listening to this as a guest and you want to say, how can I get my better returns, or how can I get more exposure into other real estate assets that you wanted to buy, cash flowing assets, then you want to give us a call. You want to connect. Okay. By using an advisor, statistics have always shown that you're better off. You're almost 3 times better off financially by using an advisor who can help you with all these decisions. So if there's any questions, by all means, you want to reach out to us. The best way to do it is if you want to reach out to myself, it would be through our assistant at latitude-west.ca and set up a time for us to talk. If you had a mortgage question with Dara at citywidemortgage.ca. And if you had a question for Ryan at rwrealestate.ca. Thanks for listening, and don't panic too much. I know the markets are pretty volatile in both the stock and the real estate market, but that's what good advisors are here for, to kind of talk you through the volatile times and show you how to take opportunities. If you've got cash and you want to deploy it, now is an absolute fantastic time. If you've got, maybe even some leverage opportunities, but you want to know how best to use it, you really, really, really want to talk with us so that we could figure out a good strategy for you. So having said that, until next time, have a great rest of the summer.